Todd Lindstrom's hand was shaking when he opened the file. Not because of the amount. $187,000 wasn't the biggest loan in default on his desk that morning in February 1993. Not because of the property. The Lindstrom farm in Brookings County, South Dakota, 640 acres that had been in the family since 1919. His hand shook because the borrower's name was Vernon Lindstrom. His father, the loan officer position at First Dakota Regional, had seemed like a gift when they'd offered it to him 18 months earlier. Business degree from South Dakota State, 5 years at a bank in Sioux Falls, then back home to Madison with a title and a future. His father had seemed proud, in his quiet way, shook his hand, said banking was honest work, never mentioned that he still owed money to the bank Todd now worked for. Todd closed the file, opened it again. The numbers didn't change. The loan had originated in 1985, peak of the farm crisis, when his father had tried to hold on by borrowing against land that was already underwater. The original bank had failed in 1987. First Dakota had bought the assets, the buildings, the accounts, and the bad loans. Loans like this one. Loans secured by farms that weren't worth what was owed on them anymore. Loans that should have been called years ago, but got lost in the shuffle of bank failures and mergers and the general chaos of trying to rebuild rural banking after the 80s tried to kill it. The file showed 5 years of irregular payments. Some months Vernon had paid. Some months he hadn't. The bank that held the note before had let it slide, probably because they were drowning in worse problems. But First Dakota Regional wasn't drowning. They were expanding. They had standards. They had shareholders. And they had Todd Lindstrom, loan officer, whose job was to clean up the mess. He'd known this moment would come eventually. You don't grow up in a farming community and go into agricultural lending without understanding that eventually you'll have to make calls on people you know. But he'd figured it would be a neighbor, a high school classmate's father, maybe someone from church. He hadn't figured it would be his own father, and he definitely hadn't figured it would be this complicated, because Vernon Lindstrom didn't look like a man in financial trouble. He drove a paid-for 1988 Chevy pickup. His equipment was old but maintained. He lived in the same house he'd lived in for 40 years, no debt on it. The farm itself was still operating, still producing, still making money. But the numbers in the file told a different story. The land was collateral on a loan that Vernon couldn't pay off and couldn't refinance because he didn't have enough equity. Not at 1993 land values. Not after what the 80s had done to South Dakota farmland prices. Todd had been 12 years old when the crisis hit. Old enough to understand that something was wrong. Not old enough to understand what. He remembered his mother's face when his father came in from coffee at the elevator and said the Johnsons were done. He remembered the auction sale at the Schneider place, remembered his father bidding on a field cultivator, and then stopping when the price got too high. Remembered the look of relief on Mr. Schneider's face when some out-of-state buyer took it for more than it was worth. He remembered the summer of 1987 when his father sold everything. Everything. The cattle went in March. Vernon had run a cow-calf operation, 90 head. Genetics he'd been working on for 15 years. Todd helped load them. His father didn't say anything while they were working, just checked off numbers on his sales sheet, and made sure each cow went where she was supposed to go. When the last trailer pulled out of the yard, Vernon went into the machine shed and didn't come out until dark. The machinery went at auction in July. John Deere 4440, 4020, for 1,010, 3 generations of tractors. International 1460 combine that was only 5 years old. The whole line of implements. Vernon had kept the bare minimum. 1 old 4020, a disc, a planter, a cultivator. Things nobody wanted to bid on because they were worn out and obsolete. Todd watched the auctioneer work through item after item. Watched his father stand apart from the crowd. Watched the numbers add up. The land stayed. 640 acres. But it stayed with a mortgage that was bigger than the land was worth. Vernon had borrowed to buy cattle and machinery and to put in drainage tile back in 1984 when everyone said the boom would last forever. The note came due in 1987. The bank couldn't get him refinanced. The land had dropped from $900 an acre to $250 an acre in 3 years. But they couldn't afford to foreclose either, not with 50 other farms in the same situation. So they'd worked out a payment plan. Interest only. Keep making payments, keep farming. And maybe someday the land would be worth enough again to refinance properly. Vernon made those payments by doing what nobody else was doing in 1987. He went cash only. No operating loans. No inputs he couldn't pay for with last year's crop. No seed on credit. No fertilizer on credit. No nothing on credit. He farmed like his grandfather had farmed in 1930. And he survived. Todd went to college on a National Merit Scholarship and summer jobs, and his mother's life insurance money after she died in 1990. He studied business because his father told him to study something that would work, whether farms went up or down. He learned about debt-to-equity ratios and capital asset pricing models and efficient market theory. He learned that his father's farm was technically insolvent and had been for a decade. He learned that Vernon Lindstrom was, according to modern financial analysis, a bad credit risk who should have been liquidated years ago. Then he got hired at First Dakota Regional and learned that theory and practice were different things. The bank's portfolio manager, Dwight Keller, was 53 years old and had been in agricultural lending since 1972. He'd seen the boom. He'd seen the crash. He'd seen what happened when banks foreclosed on every loan that went sideways. He'd been at one of the banks that failed because they called too many loans too fast and ended up owning too many farms they couldn't sell. He'd learned lessons that weren't in any textbook. The Vernon Lindstrom file. Todd said when he walked into Dwight's office that afternoon, "I need to talk about it." Dwight looked up from the pile of loan applications on his desk. "I was wondering when you'd find that one." "You knew?" "I know every loan in this bank that's more than 90 days past due. Been watching that one for 18 months, since we bought the assets from Farmers Trust." "Why didn't you tell me?" "Because it's your job to review these files. Because at some point you were going to find it. Because you needed to make the decision yourself, not because I handed it to you." Dwight leaned back in his chair. "What are you going to recommend?" "I don't know." "Yes, you do. You just don't like it." Todd sat down. "The loan's been in default for 5 years. The collateral doesn't support the debt. The borrower's making irregular payments that don't even cover interest. According to every guideline we have, we should call it. And if we call it, we foreclose, take the land, sell it at auction, take a loss on the loan, move on. And your father gets to start over. Again." Dwight was quiet for a long moment. Then he opened a drawer and pulled out another file. "I want to show you something. This is the Peterson farm. Harold Peterson, 2,000 acres in Codington County. Owed $1.2 million when we took over the loan. Land was worth maybe $700,000. We called the loan 6 months ago. Foreclosed in November. Put up for auction in December. And your father bought it." Todd stared at him. "What?" "Cash bid. $410,000. The land had been assessed at $475,000, but we couldn't get that at auction. Too much acreage, too much debt in the market. Your father showed up with a certified check and took it. That's not possible. My father doesn't have that kind of money." "He does now." Dwight pulled out 3 more files. "Hanson Farm, 800 acres in Brookings County. Your father bought it. Erickson Farm, 480 acres in Moody County. Your father bought it. Johansson Farm, 1,200 acres split between 2 counties. Your father bought it." Todd's mind was racing. "When?" "Over the last 14 months. Every foreclosure auction we've held in a 4-county area. Your father's been there. Doesn't bid on everything. Waits until the bidding stalls. Then comes in just high enough to take it. Pays cash. Signs the papers. Walks away. Where's he getting the money?" Dwight slid a piece of paper across the desk. It was a deposit statement from a savings account at their bank. Vernon Lindstrom's name. Balance, $1,847,000. Todd read the number 3 times. "How?" "Best I can figure, he sold everything in 1987. Cattle, machinery, everything but the bare minimum. Took the money and put it in CDs at 8% interest. Kept farming with old equipment and no debt. Put every penny he made from farming into more CDs. Lived on nothing. Saved everything. For 6 years. Then when land prices bottomed out and started coming back, he started buying, not with loans, with cash. Buying farms at foreclosure auctions for 30, 40, sometimes 50 cents on the dollar. Why? Why does any farmer buy land? No. Why didn't he tell me? Dwight shrugged. Maybe he wanted you to figure out yourself. Maybe he was ashamed that his son was working for the bank that was selling off his neighbors. Maybe he just didn't think it was your business. Todd looked at the account statement again. If he has this kind of money, why hasn't he paid off his own loan? Good question. You should ask him. Let me pause here and give you the historical context you need to understand what's happening in this story. According to Federal Reserve agricultural lending reports from the early 1990s, commercial bank portfolios in the Midwest were still recovering from the farm crisis of the 1980s. In South Dakota specifically, farmland values had crashed from an average of $549 per acre in 1982 to $179 per acre in 1987, a 67% decline in 5 years. By 1993, when this story takes place, values had recovered to around $350 per acre, but thousands of loans written during the boom years were still underwater. The bank consolidation Todd's dealing with was real. According to FDIC data, 372 agricultural banks failed between 1985 and 1992. Surviving banks bought the assets, including the loans, of failed banks, which meant loan officers like Todd were often dealing with debt they didn't originate, on farms they'd never evaluated, in situations where the original terms had been made under completely different economic conditions. The cash farming strategy Vernon used was rare but documented. University of Nebraska Extension Service research from 1993 showed that farmers who eliminated all operating debt and farmed with equity-only financing had lower gross revenues but higher survival rates. They were farming like it was 1930, and for some of them, it worked. Now, about those foreclosure auctions. This is real. Agricultural land at auction in the early 1990s was selling for significantly less than market value because there were too many sellers and not enough buyers with financing. Cash buyers had enormous advantages. A USDA Economic Research Service study from 1994 found that farmers with cash were buying land at auctions for an average of 62% of appraised value. Vernon's strategy of waiting until foreclosure auctions and buying with cash was unusual in its scale, but it was happening across the rural Midwest. If you were working in agricultural finance in the early 1990s, or if your family was navigating this transition, I want to hear about it. Was your bank doing foreclosure sales? Were you seeing cash buyers come in and take land? What was it like watching the recovery happen while some families were still losing everything? Leave your experience in the comments. The drive out to the farm took 20 minutes. Todd had grown up making this drive, knew every curve, every field, every house along the way. He'd driven it coming home from college for Christmas break, for summer vacations, for his mother's funeral. He'd driven it last Thanksgiving, sitting at the kitchen table and making small talk with his father about nothing important, never knowing that Vernon Lindstrom was sitting on nearly $2 million while living like a man on the edge of poverty. The yard looked the same as it always had. Old machine shed with peeling paint. House that needed new siding. The 4020 parked by the fuel tank, older than Todd by a decade. No sign of wealth. No sign of 4,000 acres of land accumulated through foreclosure auctions. No sign that the man who lived here had outmaneuvered every bank in the region, including the one his son worked for. Vernon was in the machine shed, doing something to a planter. He looked up when Todd's car pulled in, nodded once, went back to work. Dad. Todd. We need to talk. About your loan with First Dakota Regional. Vernon straightened up, wiped his hands on a rag that was already filthy. Figured you'd get to that eventually. You've been in default for 5 years. Yep. The bank's going to call it. Probably should. Why haven't you paid it off? Vernon looked at him for a long moment. You know why? No, I don't. Dwight showed me your account. You got almost $2 million in CDs. You could pay off this loan 20 times over. Why haven't you? Because the day I pay it off is the day I prove their whole system right. What are you talking about? Vernon walked over to a workbench. picked up a folder that had been sitting there. You see this? This is the original loan application from 1985. Right here, the signature. That's Mike Sullivan, loan officer at Farmers Trust. He called me in March of 1985. Said land values were going up 10% a year. Said I should leverage my equity to expand. Said I could buy the Schultz place, run more cattle, tile the whole farm. Said the bank would back me. Said it was safe. Dad, that was 1985. Everyone thought. I know what everyone thought. And Mike Sullivan knew too. But he wanted to write loans. Bank wanted growth. So they lent money against land that was inflated, for projects that didn't make sense, to farmers who couldn't afford the debt. And when it all fell apart, you know what Mike Sullivan did? He left, went to work for a bank in Minneapolis. Left all of us here holding the bag. Vernon opened the folder. This is my payment record. March 1987. I owed $212,000. Interest rate was 11%. Payment was supposed to be $23,320 a year. You know what my net farm income was in 1987? After I sold the cattle and machinery? $18,000. I made my payment anyway. Borrowed from my mother. Paid it. He turned a page. 1988. Same thing. Payment due. $23,320. Net farm income. $21,000. I made my payment. Borrowed from my brother. Paid it. Another page. 1989, 1990, 1991. Every year. I made every payment I could make. Some years I was short. Some months I was late. But I tried. And you know what the bank did? Nothing. They didn't refinance me. They didn't work with me. They just let the loan sit there, accumulating penalties and late fees, until they could sell to another bank and make it someone else's problem. That's not how it works. That's exactly how it works. And now you're sitting here telling me the bank's going to call my loan after I survived the 80s, after I paid off everything else I owed, after I did what they all said couldn't be done. Vernon's voice was level, not angry, just stating facts. So I'm going to make you a deal. You tell your bank to foreclose. Put my land up for auction, and I'll buy it. Cash. Same as I've been buying every other farm you take. Why? Because I can afford to pay what it's actually worth, not what they lent on it. Because I'm not going to let them make a profit on paper they never should have written. And because I want you to understand something. Vernon closed the folder. Every farm I've bought, I've helped the family stay on it. I don't kick them off. I lease it back to them. Flexible rent based on yield, not cash rent they can't afford. No debt. If they can't make it, they walk away with their equipment and no bankruptcy. If they can make it, they keep farming and maybe someday they buy it back. Todd stared at his father. You're running your own land bank. I'm doing what the banks should have done in 1987. I'm helping farmers survive instead of helping investors extract value. That's not sustainable. You can't. Can't what? Can't use my money how I want? Can't offer terms that actual farmers can work with? Can't prove that there's a better way? Vernon picked up a wrench, turned back to the planter. You work for a bank. Todd. That's fine. It's honest work. But don't confuse honest work with right work. The banks destroyed rural America in the 80s. Now they're buying up the pieces cheap and pretending they're helping. I'm buying up the pieces cheap and actually helping. You decide which one you want to be part of. Todd drove back to town. He didn't know what he was going to tell Dwight. Didn't know what he was going to recommend on the file. Didn't know how to reconcile what he learned in school, that banks needed to protect their assets, that foreclosure was sometimes the only option, that sentiment couldn't override fiduciary duty. But what his father had just shown him. The next morning, he put the Vernon Lindstrom file back on Dwight's desk. I can't make the call on this one. It's a conflict of interest. Dwight looked at the file, then at Todd. What did he tell you? That he's running a better bank than we are. And is he? Todd thought about it. I don't know. What he's doing only works because he survived the crash with capital. How many farmers could do that? 1 in 100? 1 in 1,000? The other 999 needed loans to survive, and someone had to decide who got them and who didn't. And you think we made those decisions right? I think we made them according to the rules. Whether the rules were right is a different question. Dwight opened the file. I'm going to make a recommendation to the board. We're going to restructure this loan. We'll write down the principal to current land value, extend the term, and lock in a fixed rate at current market. Your father will have payments he can actually afford based on realistic land values. The bank will take a loss on paper, but we'll get a performing loan instead of a non-performing asset. And maybe, just maybe, we'll do one thing right out of all this mess. The board won't approve it. The board will approve what I tell them to approve. I've been doing this for 20 years. I have credibility, and I'm going to spend some of it on this. Why? Because your father's right. We should have done this in 1987. We should have written down debt across the board, restructured based on reality instead of hope, and helped farmers survive instead of waiting for them to fail. We didn't. Most banks didn't. And thousands of families lost everything because of it. I can't fix that, but I can fix this one. Dwight closed the file. Also, because Vernon Lindstrom has done more for agricultural lending in this region than this bank has. He's keeping families on the land. He's providing real financing alternatives. He's proving that you can make money and still have a conscience. And if we foreclose on him after all that, everyone will know we're the bad guys, including us. The loan restructure went through in April. Vernon's debt was written down from $187,000 to $128,000 based on current assessed value. The term extended to 15 years. The rate locked at 7.5%. Monthly payment dropped to $1,180, which Vernon could cover with cash flow from his own 640 acres alone. Vernon made the first payment on time, and the second, and the third. Over the next year, he bought 3 more farms at foreclosure auctions, always paying cash, always offering leaseback arrangements to the families who'd lost them, always operating the gap between what banks said was possible and what farmers needed to survive. Todd stayed at First Dakota Regional. He learned to look at loans the way Dwight did, not just as numbers on paper, but as families trying to make a living on land that gave them no guarantees. He learned to ask different questions during loan applications. Not just, can you afford this, but what happens if you can't? What's your plan B? What's your plan C? He learned that the best loans were the ones that never needed to be called because they were written with enough margin for the inevitable bad years. By 1996, land values in South Dakota had recovered to $425 per acre. The farms Vernon had bought for $250 to $300 per acre were now worth significantly more. But he wasn't selling. He was holding, collecting lease payments, letting families rebuild equity, operating what was essentially a parallel banking system designed around farmer survival instead of bank profit. I need to give you some economic context here about what Vernon was doing, because it connects to something that was happening across the Midwest in the 1990s. According to a 1997 study by the University of Minnesota Extension Service, alternative financing arrangements, private land contracts, lease-to-own agreements, and seller-finance purchases increased by 47% between 1992 and 1996. These arrangements existed because traditional bank financing wasn't working for many farmers, especially beginning farmers or those recovering from the 1980s crisis. Vernon's model was more aggressive than most, but the principle was sound. He was buying distressed assets at auction, then converting them from bank-owned property back to productive farmland operated by families who knew how to farm it. The leaseback arrangements meant those families stayed on the land, maintained it, and had a chance to rebuild their financial position. Some would eventually buy the farms back. Some wouldn't. But they all got something they wouldn't have gotten from a bank: time and flexibility. The economic logic was interesting, too. Vernon was earning less per acre in lease payments than he could have earned in cash rent on the open market. But his risk was lower because his total investment was lower, and his operators were highly motivated because they knew the land. According to Farm Management Association data from Iowa State University in the mid-1990s, farms operated by owner-tenants with lease-to-own arrangements had 12% higher yields and 23% lower input costs than farms operated under standard cash rental agreements. Skin in the game mattered. What Vernon understood, and what the banks were slow to learn, was that farming wasn't just about matching assets to liabilities on a balance sheet. It was about keeping people on the land who knew how to work it. The 1980s crisis had proven that if you took experienced farmers off their land and replaced them with financial operators or investor groups, productivity dropped. The land suffered. The communities suffered. The economics didn't work even for the banks. If you were farming in the 1990s and dealing with these alternative financing arrangements, I want to hear about it. Did someone give you a second chance through a leaseback deal? Did you know farmers who stayed on their land because of private financing when banks wouldn't touch them? This was happening everywhere, but we don't talk about it much. Share your story in the comments. In 1998, the bottom fell out again. Not like the 80s. This was smaller, sharper, focused on specific commodities. Hog prices collapsed to $8 per hundredweight, lowest in 50 years. Some grain prices followed. The Freedom to Farm Act, which was supposed to let market forces work, was proving that market forces could be brutal. Emergency farm payments went out. Again, Todd saw the loan applications change. Farmers who'd survived the 80s and were rebuilding through the 90s suddenly needed operating capital to cover the gap. Some of them would make it. Some wouldn't. The bank's job was to figure out which was which and allocate capital accordingly. One afternoon in November 1998, a farmer named Mike Schultz came into Todd's office. He was 37 years old, farming 1,200 acres, 800 that he owned and 400 that he leased from Vernon Lindstrom. He needed a $45,000 operating loan to get through to next year's crop. Your balance sheet looks tight, Todd said, reviewing the application. It is. Hog operation took a beating this year. I got grain to sell, but prices are terrible. I need to hold until spring, which means I need capital to cover inputs for next year. Have you talked to Vernon about extended payment terms on the lease? Mike shook his head. He already gave me terms that no one else would. Cut my lease payment by 15% last year when yields were down. I can't ask him to take less. He's doing me a favor, just letting me farm that land. Todd ran the numbers. Mike Schultz was a good farmer. Good records, good yields, good management. He'd survived the 80s by selling out early, before debt crushed him. He'd spent 5 years working as a hired man and saving money. He'd bought back 800 acres in 1993, paying cash for land at auction. He'd been building ever since. But 1998 was testing him. I can get you approved at 8.5% for 12 months. You'll need to provide quarterly financial statements and maintain a minimum cash balance of $15,000. Can you work with that? Yes. They processed the paperwork. Mike left with his operating loan. Todd filed the approval with notes about risk factors and monitoring requirements. Standard stuff. But he thought about what his father had said years earlier, about helping farmers survive instead of extracting value, about the difference between honest work and right work. That same week, Vernon bought another farm at auction, the Bergquist Place, 960 acres in Brookings County, foreclosed after 3 years of bad yields and a debt structure that never made sense. The family had been there since 1947. They were devastated. Vernon paid $298,000 for land assessed at $380,000. Then he found Tom Bergquist and offered him a deal. Lease it back for 5 years at flexible rent. 20% of gross yield value, adjusted each year based on actual production. No minimum payment. If crops failed, rent was zero. If crops were good, Vernon got 20% of the value. After 5 years, Tom would have the option to buy it back at Vernon's cost plus 4% annual appreciation. Tom Bergquist took the deal. He kept farming. His kids stayed in school in Madison instead of moving to Sioux Falls. His family stayed together. The land stayed productive. Todd heard about it through the bank's network. News traveled fast in farming communities, especially news about foreclosures and what happened to the families afterward. He called his father that night. The Bergquist Place. You bought it. Yep. What are you going to do with it? Same thing I've done with all of them. Keep it working. Dad, you own over 5,000 acres now. That's not a farm anymore. That's a land company. It's a farm as long as farmers are working it. But you're not farming it. You're leasing it out. Tom Bergquist is farming it. Harold Peterson is farming 2,000 acres of what I bought. Mike Schultz is farming 400 acres. The Hanson boys are farming 800 acres. 10 different families are farming land I own because the bank you work for took it from them. I'm just holding it until they're ready to take it back. And if they never are, Vernon was quiet for a moment, then I'll find someone who will. Someone who actually wants to farm instead of just own land. In 1999, Todd got promoted to portfolio manager. Dwight was retiring after 27 years. The bank was doing well. Consolidation had given them market share. The late 90s recovery had reduced defaults, and new precision agriculture loans were opening up profitable lending opportunities for technology adoption. Todd's first decision as portfolio manager was about a $175,000 loan application from a young farmer named Jason Mueller, 28 years old, wanted to buy 320 acres and a small equipment line to start his own operation. He had $40,000 for a down payment, solid references, and a degree in agricultural business from South Dakota State. But his debt-to-equity ratio was terrible because he was starting with almost nothing. Under standard lending criteria, it was a rejection. Too little equity, too much risk, too uncertain. Todd approved it anyway. 7% fixed for 20 years. Required quarterly financials and a farm management plan. But he approved it. The board questioned it. Todd explained his reasoning. The land was good. The price was fair. The young man had training and motivation. And someone needed to give beginning farmers a chance, or there wouldn't be any farmers left in 20 years. The loan performed. Jason Mueller made every payment. 3 months later, Vernon came into the bank. Todd was surprised. His father never came to the bank, always did business by mail or phone. "I'm selling some land," Vernon said. "Which parcels?" "The Peterson farm, the Hanson place, the Erickson ground, about 3,400 acres total." Todd pulled up the property records. "That's prime land. Why sell now?" "Because the families farming it are ready to buy it back. They've rebuilt their equity. They're ready to own instead of lease. I'm selling it to them at my cost plus 5% compounded annually. They'll finance through other banks. Your bank if they want. I don't care. But they're buying it back. You're leaving money on the table. That land's worth significantly more than you're selling it for. I'm getting paid exactly what I should get paid. A fair return on capital over time. I'm not interested in extracting maximum value. I'm interested in keeping farmers farming." Vernon stood up. "I've got one more thing. I'm setting up a fund. $300,000. It'll provide down payment assistance for beginning farmers who can't get traditional bank financing. No interest. They pay it back when they're able. If they fail, the fund takes the loss. If they succeed, the money goes back in the pool for the next person. That's a grant program, not a loan program. Call it whatever you want. I call it investing in the future." Vernon headed for the door, then stopped. "You did good work on that Mueller loan. Dwight told me about it before he retired. Said you were learning to look past the numbers to see the people. That's the difference between being a banker and being a bank." After Vernon left, Todd sat at his desk and thought about the previous decade, about his father foreclosing, about watching Vernon buy farm after farm at auction, about the families who stayed on the land because someone gave them terms that banks wouldn't, about the difference between what's profitable and what's right. The agriculture finance landscape was changing. Precision farming was creating new lending opportunities. Larger operations were consolidating more land. The factory farm model was spreading. Banks were financing larger and larger operations while squeezing out smaller ones because the numbers made more sense at scale. But Vernon Lindstrom had proved something else was possible. That capital could be deployed for long-term community benefit instead of short-term maximum extraction. That keeping experienced farmers on the land was more valuable than replacing them with operators. That flexibility in financing could produce better outcomes than rigid adherence to standard terms. I want to pause here and give you the contemporary connection, because this story isn't just history. The beginning farmer crisis that Vernon was addressing in the 1990s is worse now. According to USDA data from 2022, the average age of American farmers is 57.5 years old. Less than 8% of farmers are under 35. The average beginning farmer needs $600,000 in capital to start operations, and traditional bank financing requires 30 to 40% down payment plus operating capital reserves. The math doesn't work. Alternative financing models like Vernon's, lease-to-own arrangements, land contracts, beginning farmer funds, are making a comeback. Organizations like the National Young Farmers Coalition and state-level farm transfer networks are promoting exactly the kind of arrangements Vernon pioneered, not because they're charitable, but because they work. The economic principle is the same as it was in the 1990s. If you want agriculture to survive long-term, you need to create pathways for new farmers to enter the industry. If the only pathway is inheriting a multi-million-dollar operation from your parents, you don't have an industry. You have an aristocracy, and aristocracies don't last. If you're dealing with these issues now, trying to start farming without family land, trying to transfer your farm to the next generation, trying to keep your kids in agriculture, I want to hear about it. Are you seeing alternative financing models work? Are banks getting better or worse at serving beginning farmers? What's changed since the 1990s and what stayed the same? Put it in the comments. By 2000, Vernon Lindstrom had sold or sold back 2,800 acres to the families farming it. He still owned 2,400 acres that were leased out under flexible arrangements. His beginning farmer fund had helped 6 young farmers with down payments, 4 were still farming. 2 had failed and left agriculture, but they'd left without bankruptcy or destroyed credit. Todd had built First Dakota Regional's agricultural lending portfolio to $47 million. Default rate was under 2%. The bank was profitable. But more importantly, the bank was financing farms that were actually working. Sustainable operations with real economics instead of speculative ventures built on inflated land values. Father and son never talked directly about what had happened in 1993, when Todd had opened that file and found his father's name on a defaulted loan. They never discussed whether the foreclosure threat had been right or wrong, whether the bank's policies were just or unjust, whether Vernon's response was vindication or vengeance. But they talked about farming, about land values, about beginning farmer programs, about which loans made sense and which didn't, about how to balance profit and purpose. On Thanksgiving 2000, Todd was at his father's house. Vernon was 74 years old, still farming his original 640 acres with equipment that was older than some of the farmers leasing his land. They were sitting in the living room after dinner, watching it get dark outside. "I've been thinking about something," Todd said. "When you bought all those farms at auction, when you set up the leaseback arrangements and the beginning farmer fund, was that about helping people, or was that about proving the banks wrong?" Vernon thought about it for a long time. "Both," he said finally. "I wanted to prove you could make money and still have a conscience. I wanted to prove the bank's way wasn't the only way. But mostly, I wanted to keep families on the land, because I knew what it felt like to almost lose it. And I knew what I'd give to make sure nobody else had to feel that way if I could prevent it. Did it work? Ask the 10 families still farming land I bought. Ask the 6 kids who got down payment help from a fund. Ask yourself if First Dakota Regional would have approved the Mueller loan if you hadn't seen what I was doing." Vernon looked at his son. "You thought I was angry when you became a banker. I wasn't. I was hoping you'd be the kind of banker who remembers that loans are about people, not just paper. I'm trying. I know. Dwight told me before he retired. He said you were better at it than he was. Said you had the numbers and the heart. That's what agriculture needs in the next generation. People who understand both." They sat there as the last light faded from the fields. 2 men who'd approached the same problem from different angles. One from inside the financial system, one from outside it. Both trying to figure out how to keep farming viable for families instead of just corporations. The 1990s had been about recovery and transition. Recovery from the 80s crisis. Transition to new technology, new markets, new ways of farming. Vernon and Todd had navigated that transition on different paths, but they both arrived at the same conclusion. Agriculture works when it serves the people doing the work, not just the people providing the capital. Vernon passed away in 2003. He was 77. His will specify that the remaining 2,400 acres he owned should be sold to the families farming it at his cost basis, with any unsold land going to the beginning farmer fund as an endowment. Todd handled the estate settlement. Every family farming Vernon's land bought their parcels. The fund received no land, but it received $200,000 in cash from Vernon's remaining savings. Todd still runs that fund. It's helped 23 beginning farmers with down payments over the past 2 decades. 15 are still farming. 8 aren't. The success rate isn't perfect, but it's better than letting land consolidate into larger and larger operations run by investors who've never touched a plow. The bank Todd works for, now part of a regional banking group after another merger, still does agricultural lending. But the principles that Dwight, Todd, and Vernon demonstrated are still there in how they evaluate loans. Not just when you pay, but what happens if you can't. Not just profit maximization, but community sustainability. The lesson from 1993, when a banker found his father's name in a foreclosure file, wasn't that banks are wrong or that farmers are always right. It was that finance and farming need each other, but only when both sides remember they're serving the same ultimate purpose, keeping land productive and families working. Vernon Lindstrom proved you could make money in agriculture without destroying the people who actually did the work. Todd Lindstrom proved you could work in banking without forgetting that every loan file is someone's life. The 1990s were supposed to be about recovery. For some families, they were. For others, they were about transition. From family farming to corporate farming, from traditional methods to technological ones, from local banks to regional conglomerates. Vernon and Todd lived through that transition on opposite sides of the desk. But they both fought for the same thing, a future where farming was still possible for people who wanted to farm, not just people who wanted to own farmland as an asset class. That fight isn't over. It's still happening in every loan application, every foreclosure decision, every beginning farmer trying to figure out how to start when the numbers say it's impossible. The tools have changed. Precision agriculture instead of yield maps, $500,000 combines instead of $150,000 ones, land values that make the 1980s boom look quaint. But the fundamental question remains, who gets a farm and on what terms? If you got thoughts on that question, whether you're farming now, whether you tried and couldn't make it work, whether you're a banker trying to figure out how to serve agriculture without destroying it, share them below. This channel exists to document these stories and these questions. The 1990s taught us that survival is possible but not guaranteed, that recovery is real but not universal, and that how we handle success matters as much as how we handle failure. Subscribe if you want more stories about the decade that bridged traditional farming and the digital age. And remember, every farm still operating is someone's victory over the numbers that said it couldn't be done.